Why are rich people intentionally putting themselves hundreds of millions of dollars in debt? It's simple because they understand how money actually works. Despite what most people think, debt isn't bad. Stupid debt, yeah. Strategic debt, that's actually how real wealth is built. And for context, I've raised multiple nine figures in private capital and helped our investor clients fund over $1 billion in real estate and business deals. Now, look, this isn't one of those hype videos about good debt versus bad debt. In this video, I'm going to break down exactly how wealthy people think about debt, why they're intentionally borrowing hundreds of millions of dollars, and why you're probably playing the wrong game entirely if you're trying to stay debt-free. The first thing to know here is debt is a tool. All tools have good uses and bad uses. So debt is a tool, and the problem isn't that it exists, the problem is how people use it. So for context, look, rich people use debt to buy income and assets. Broke people use debt to buy liabilities, vacations, clothes, distractions. Going on a cruise because you need it to clear your head and spend $10,000 for a week for you and your family to just relax and take the stress off everything that's going on, that's not an investment. And if you're putting that on a credit card where you're going to be paying 29.9% interest rate, that is definitely bad debt. Now, on the flip side, if you're using debt to buy an apartment building and you're borrowing $1 million or $2 million or $10 million or whatever amount of money you're borrowing, but if that borrowing, that debt allows you to acquire an asset that then your tenants are going to turn around and pay you rent every month, and you're generating enough rent income every month to cover the debt and your expenses, and you have some cash left over, that is then an asset. So for context, I recently guaranteed $11.5 million in debt. Why did I do that? Well, for me, that debt actually makes me wealthier. So let me explain. We bought 144 units in Houston, Texas a couple years ago. Recently, we had it reappraised. It came in at around $18 million. So we did a cash out refinance where we were able to refinance that property and pull out a whole bunch of capital, tax deferred. It was a couple million bucks, tax deferred because it's not a sale. It's just a refinance. We took on more debt. And because the property generates about $155,000 a month in gross revenue, I think $55,000 or $58,000 monthly mortgage, again, interest payment against that property, well, that's an example of where debt is actually an asset because we're able to keep the asset, the tenants are paying the bills, and we're able to pull some of our capital out and keep the entire property in a really good cash flow position. Or contrast that to some of the things that people rack up credit cards and lines of credit against. Those couple thousand or tens of thousands or hundreds of thousands of dollars in debt that you have, if there's no asset to pay for it, guess what? You're the one paying for that monthly expense. So that's a really good example of where debt can either enslave you or it can empower you. If you're taking out debt on credit cards and lines of credit to go on trips or vacations, you have to pay that off personally. Whereas the $11.5 million we borrowed against this property, that's money that we now have back in our pockets. We are able to distribute to us and our investors. And ultimately, that debt is being paid off by the tenants that live at the property. That brings me to my second point. The actual asset isn't the real estate or the business. The real asset is the income it generates. Look, a rental property isn't an asset because of the walls. It's valuable because someone's paying rent. A Ferrari can be an asset. Literally, if you buy a Ferrari and you rent it out and you cover your payments and make money, that can be an asset. A hot dog stand can be an asset. Look, anything can be an asset. It's just a matter of where is the cash flowing? Is it flowing into your pocket after all the expenses? Or is there more money going out than coming in? If there's more money going out every month, you've got a liability, whether it's real estate, a car, whatever it is. If there's more money going out than in, that is, my friend, a liability. The third part to all of this is the bigger the deal that you're working on, in my opinion, the less risk you actually have if you know what you're doing. Because the bigger the debt, the more money you have to actually hire the right people to make better decisions. Look, the biggest problem most real estate investors have is that the deals that they're working on are just too small. So they can't actually afford They literally can't afford to hire the right people. Small deals force you to think small. It forces you to cut corners, hire cheaper contractors, get bad legal or no legal, and you've got literally zero margin for error. So in my world, the bigger the deal, the bigger the budget you have, and the better team you can hire, the better decisions you can make, the higher the margins and the less risk you actually have. Plus, when you take on more debt, more of the good debt that actually generates you income, what ends up happening is you actually end up having the people that are lending you money be more partner oriented as opposed to collector receiver oriented. And what I mean by that is, well, I was at a conference years ago in my early 20s, and Robert Kiyosaki was on stage and he said something to the extent of, if I have $1 million in debt that I can't pay for, I have a problem. If I have $1 billion in debt, the bank has a problem. So they're very interested in helping me resolve my problem. Now, I'm not saying you take on debt and create problems for yourself and your partners, but the point is, the bigger the deal, the smarter people around the table to help you figure things out if things don't work. There's nothing worse than being jammed up with a $50,000 credit card bill because you bought clothes you can't afford, went on vacations you can't pay for, and you're making a car payment you got no business driving. No one's coming to save you. That is your problem. Now, contrast that $50,000 credit card, that's your problem. If you have $5 million in debt on an apartment building where you have 50 or 100 people living, you've got the money and the resources to actually help you figure things out if you run into problems. And the last piece to all of this is the tax code was built to reward people that actually take on smart debt. Look, the IRS tax code is created specifically to make interest on your mortgage tax deductible because they want to create an environment where you borrow money. Borrowing helps grow the economy. By borrowing money and by spending money on things that become more valuable, like real estate, like a business, you're creating jobs, you're hiring people, you're engaging lawyers, real estate agents, mortgage agents, there's fees, there's bills, there's a receivable. You're no longer just consuming a trip or a vacation where you are the product. You are creating an environment where other people can put food on their tables because you're creating jobs and opportunities for them to be able to help restore a neighborhood, build a business. You're creating activity and volume. And that's why the IRS, in my opinion, created a model where you're incentivized to take on debt. Now, the question is, are you going to take on the kind of debt that helps you become wealthy? Or are you going to trap yourself in the short term pleasure seeking activities of just living in the moment? And I'm stressed out. I got to go on a trip. I got to go on a vacation. I got to buy a new pair of shoes to make myself feel better. So, look, if you're still thinking about debt the way you were taught in school, you're already behind. The people you're actually trying to compete with, they're taking on tens, even hundreds of millions of dollars in debt to get ahead. They've got the right debt on the right assets. And because of that, they're being disproportionately rewarded. So, look, the next time someone tells you debt is dangerous, literally ask them what kind of debt they're talking about and what they're actually planning on doing with it. And look, if you're a real estate investor, entrepreneur, fund manager, capital raiser, business owner, and you want more of this type of content, make sure you hit the subscribe button to catch me on the next video.